Alright, how is everyone? This is my third video on Lease rental model, and if you haven't watched my previous videos, I recommend you that you watch my previous videos. This is the third video and we will be continuing from where we left. So just to give you a brief introduction what we did in last two videos. Basically what we did was we calculated our revenue from our rentals, that is lease rentals, and we calculated our administrative expense in our first video. Then in the second video what we made the assumptions of land. We purchased land over here, and we constructed buildings over here. We constructed 3 buildings over here, and this is our income statement till now, and we will be continuing further. So let's dig in. So what I'm going to do right now, so I'll be building my capex schedule, and we're going to calculate the depreciation, and then we'll be filling our balance sheet up. So, and in addition to that, we'll put our depreciation over here, and we'll make an assumption of taxation, simple taxation. So let's get started. Click on the capex sheet, and as you can see the capex sheet, there is some data in the capex sheet that has been linked to our assumptions tab. And if we go to the link over here, as you can see it has been linked over here. So we are purchasing land in the first year, and this is going to our capex schedule. Furthermore, down the line when we go to buildings, we see that it has been linked to the buildings over here, and since it has been linked to the building over here, and we are constructing our building the first year, so hence it's showing the value of 500 million. So what we're going to do right now, we're going to calculate our depreciation. We're going to link the depreciation over here and feed it into our capex model, and the sheet will automatically calculate our depreciation and net book value. So let's do it. Alright, so as we move down here, open your depreciation, just open your depreciation schedule and move above to okay. So land does not depreciate, so we have not entered any year over here. Building, we are assuming that the useful life of the building will be for 20 years, and I think we just need to delete the data over here. Fine, let's go to the depreciation schedule. Let's write buildings over here, and let's go to the price section. Our price is going to be, so our price is going to be this over here. So let's link it up. Alright, year. So we want, since we are constructing our building in the first year, the depreciation will start from the second year. So we'll write 2 over here. Salvage value, let's put it 0, and life, we're going to link it from over here. Let's go with life, and the life is 20 years. Press enter, and as you can see depreciation has automatically been calculated. This is our total depreciation. So let's link this depreciation to our income statement. So let's put it over here, and before we do that, let's just feed the depreciation. Yes, it has already been feeded. Yes, as you can see the links have already been put there. So we just need to link our depreciation from over here. Let's go from income statement, depreciation, and click on the capex schedule. Depreciation during the year. For the year, first year we have no depreciation because we are constructing the building, and the depreciation will start from the second year. Alright, good. Now let's go back to the capex schedule and see our net book value. These are the net book values. We'll fill the balance sheet items from over here. We will show land separately and building separately. Let's go to the balance sheet, and in the fixed assets, let's put it as land over here. Okay, there is a thing that you need to be aware of. Since we are building a financial model, it is not necessary that we follow the international financial reporting standards or GAAP over here. The lease standards, there is a different accounting treatment over here. It is not binding upon us that we follow it, but it would be better if we do. Over here I am not, and plus it will get a bit complex if we go to the accounting treatment. Right, so let's go with the land and control land and building. Okay, so what's happening over here? Since the land does not depreciate and each year depreciating, giving more, is giving an additional installment, and this is being reflected on our balance sheet. So hence the land is increasing. But as you see, if you link to our building in the capex schedule, you'll be seeing that it is decreasing. It is decreasing from the second year, because in the first year we constructed the building, and from the end of the second year we have charged depreciation upon it, and hence the building is decreasing year on year, as it is evident from over here. So let's say, okay, so this is our total fixed assets, fine, and let's go with current assets. Let's just say, okay, trade receivables. Let's just say trade receivables are going to be 1 month of our revenue. Statement, and this is over here, select over here, divided by 12, and okay, these are our trade receivables. Let's just check the link over here, and okay, everything is good and fine. Now let's go with the trade payables. Okay, the trade payables have already been linked. It's 1 month of cost of sales. And let's go with balance sheet, and as you can see, income statement C23, income statement C23 is over here. So it's the payables are 1 month of operating cost. Okay, fine. Let's go back to the balance sheet and retained earnings. Okay, it's over here, retained earnings. Before we can put our retained earnings, we need to go to our income statement, complete our income statement. So we have assumed that we are funding our project from all equity, so the finance cost is going to be 0. In real life, generally we do use debt, but for simplicity's sake, in this model I have not used debt. Let's go over taxation. Okay, so what is going to be our tax? Let's just say the tax is going to be 30% for net profit, but we need to calculate it before. So let's go with the EBITDA, and let's just say that revenue minus of operating cost is going to be EBITDA. EBITDA stands for earning before tax, tax, depreciation, and amortization. So this is our EBITDA. This has been charged. We have charged depreciation over here. Let's just link it up. This, and this over here is earning before interest and tax. There is no finance cost. So net profit before tax is going to be this minus this, and yeah. Taxation. Let's just say tax rate is going to be 30% of our profit before tax. So let's just say this into 30%. Alright, so this over here, this minus this is our net profit, and our net profit is 55.25, 55, and it seems it's a good thing it's rising. Let's go back to the balance sheet and let's link up the retained earnings over here. Just to say, let's say income statement, control right. Okay, so one thing you need to remember is that what is our retained earning? Retained earning is the years before retained earning plus this year's profit. So what we're gonna do is plus this, and this is our going to be total retained earnings. So I will finish my video over here, and in the next section we are going to calculate our paid up capital, and that is going to come from our funding requirement, and the funding requirement is going to come from cash flow. So hope to meet you soon. Stay tuned, and if you find my content valuable, please hit like and subscribe to my channel. This is Abdul Basatali. Thank you very much.